Bush. I've been teaching accounting for about 30 years and been a CPA for that long also. I've got lots of great ways to explain accounting, and I'm so glad you're here. Let's get started on today's lesson. So what we're doing is we're learning how to fix accounting mistakes. And today, somebody forgot to accrue salaries at the end of the accounting period, and we're going to fix them. A long time ago, I had my own accounting practice, and I fixed lots and lots of mistakes. A lot of times it was my fault, and most of the time, though, I was fixing the mistakes of other folks, and I got to be really good at it. I thought it was a lot of fun. You had to be a little bit of a detective to figure out what to do, but there's kind of a systematic way of doing it. And what I've done here is I've set up a 7-step process to fix mistakes. And you might say, 7 steps? That sounds like a lot of steps. Well, after a while, you get really fast at it, and it all becomes second nature. But what I'm doing here is I'm just spelling out the 7 steps that I go through. And oftentimes each step takes maybe 1 second or 2 seconds to do. So going to the steps, here we go. So here's what's going on. First of all, got to figure out, well, what did the company do or what did they not do? When did they discover the error? So you're trying to figure out what's going on. So here's the error. On December 31st, 2001, the company failed to record accrued wages in the amount of $1,500. So right at the end of the year, they made a mistake. They forgot to record wages that were earned. The workers earned the wages, but were not yet paid. On the first payday of 2002, the company debited wages expense for $1,500. So right here at the beginning of 2002, the company debited wages expense, which they should not have done. They should have debited wages payable. And they didn't discover it all until the end of 2002. So what's the result? It's like, so what? Okay, so they made a mistake. Well, wages expense for 2001 is understated, and wages expense for 2002 is overstated. So it has to do with profitability. And the error was discovered at the end of 2002. So the next step here that you would want to do is, well, were there any incorrect entries done or not done? And when were they done? And what were the incorrect entries? So we're still trying to figure out what's going on. So at the end of 2001, they did not accrue wages for $1,500. So they didn't do a journal entry. They should have, but they didn't. And at the first payday of 2002, they debited wages expense, which they should not have done, and they credited cash, which is okay. They should have credited cash. So that's what they did in essence. Very easy mistake. It's a very common mistake. So step number 3 is, well, what should they have done? What would have been the correct entries if they would have done the correct entries? And the reason why it's important to do this step is you want to know what you're aiming for. You want to know what result you want to get after you have fixed the books or corrected the books. Maybe fixed the books is the wrong way to say it. So December 31st, 2001, well, if they would have done things correctly, they would have debited wages expense. They would have credited wages payable. And on the first payday of 2002, they would have debited wages payable and credited cash. So very simple entry, but it's easy. It's an easy mistake to make. Now, one thing that you want to notice is that that wages payable gets canceled out. Look at this. It's being credited in the first entry, debited in the second entry. So when we finish mending these books, correcting these books, we don't want to have any wages payable floating around here. We should not have that, because if things would have been done right, we would not have wages payable. So coming down here, the next step here, are the books open or closed? Well, the books for 2001 have been closed. They're completely closed. There's no way to go back and fix those mistakes. There's no way to go back and change those journal entries. And this is a safety feature, so fraud doesn't happen in accounting. And the books for 2002 are still open. Now, this is a good thing because that means that all the accounts for 2002 can be changed and errors can be reversed out, which I like to do. We need to avoid creating new errors. And I remember oftentimes when I was fixing books, sometimes I would do a correcting entry and it would make things worse, which was no big deal. I would just reverse out what I did and start over and try again. So coming down here to step number 5, see, we're at step number 5 already. Well, this is the way I like to do it. is step number 5. If incorrect entry made in the current year and books open, we can reverse out the incorrect entry. So in other words, the books for 2002 are still open. So we can change those. And there was an incorrect entry done in 2002. Here it is. They debited wages expense, credited cash. Now, what I like to do, this is just me, this is the way I thought things through. I like to reverse that entry out, get rid of it. And that way it simplifies things. It clears away some of the mud and dirt. And so on December 31st, when they discovered the error, if they wanted to reverse out the bad entry for 2002, they could debit cash, credit wages expense. But they've got to now fix things. We've just got rid of the bad entry, so now we need to fix things. So step number 6, make the correct entry. And here at the end of 2002, December 31st, 2002, I'm debiting retained earnings for $1,500 and crediting cash. Now, I would love to go back and debit wages expense for 2017, but the books are closed in 2017, so the books for 2017 are off limits, can't touch them. And so, which reminds me of an MC Hammer song, can't touch that. So anyways, when it comes to 2017 entries, you can't touch those. So retained earnings is our only choice. In fact, when you're fixing mistakes, oftentimes the account retained earnings becomes your very best friend. So the only thing I can do is debit retained earnings for $1,500 and credit cash. And that will get me back to where I need to be. And if you notice here, in my reversing entry, I debited cash for $1,500 and I'm crediting cash for $1,500 in my correcting entry. Well, what that cash, therefore, is really not affected. I'm debiting and crediting it, so really not doing anything to it. But the reason why I like doing it in 2 steps like this is because it serves as a better record of what I did and my thought process and the entry that went wrong. And what I would do when I was correcting entries, I would make big, long explanations of what I was doing in the notes to these journal entries or in a separate record that I would keep, because correcting entries are just different and weird. They're not standard and normal, and so they kind of stand out. And so you want to have a good record of why you did things. So in case you're asked, if an auditor or the IRS or somebody asks, you can explain what you did. So this entry here, the reversing entry and the correcting entry, they really simplify down to debiting retained earnings for $1,500 and crediting wages expense for $1,500. And if you were to look in your textbook and in the answer key of your textbook, that would be the answer. They would debit retained earnings, credit wages expense for $1,500. And I just did it in 2 steps, and textbooks like to cram it all into 1 step. And so if you have a professor or a teacher that doesn't like the way I'm doing it here, that's okay. It's really easy to make it look like the textbook. So here's all you do is you combine the reversing entry and the correcting entry. You combine them into 1 journal entry, and like here, cash is being debited, cash debited, retained earnings debited, retained earnings, wages expense, and there you go. And so all you do is make it into 1 big journal entry and look at what you can simplify. Well, we can get rid of cash because cash really isn't involved here. Cash, $1,500 debit, cash, $1,500 credit. We could get rid of those too. And what you end up with when you simplify, you just get retained earnings and wages expense. And that is what your textbook would say right there. So the textbook answer and my answer are totally equivalent. They both work. I like mine better because there's a better record of what I'm doing. Also, there's less chance of making mistakes if you just cram it all into 1 entry like this. So I hope this lesson helped you out here. Hope it didn't confuse you. I'll go over some more of these correcting entries too. And if you like this lesson, let me know and I'll make some more videos. And hit the subscribe button. And until next time, over and out.